Hi, this is Professor Reynolds, and welcome to Accounting 6100, the accounting portion of the course. Let me get rid of these screens. I don't know if you can see these, but so we're going to start out. This is the Wiley book that is chapter one. So you'll have, of course, 12 of these chapters. Some of them, I'm limited to 30 minutes of recording time. So let me set my timer here. And some of the chapters are a little longer. So your objective will be to watch all of these videos. Okay, so identify the forms of business organizations. Now, I'm going to start off by telling you that all public companies are C corporations. And C corporation actually stands for the tax code section. It's called subchapter C corporations. There are also subchapter S corporations, and they are corporations, but there are differences with a C corporation. For instance, there can only be 100 shareholders for an S corporation. You can't have any foreign national that has ownership in an S corporation. S corporation, their earnings are what's called pass through. So any earnings that you receive will be taxed to the individual. A corporation is taxed as a entity. Corporation is an entity. So it's easier to transfer ownership. I can transfer, sell my stock, buy stock. The owners of the corporation are the shareholders. So if you own stock in a company, you're a part owner. So I'm a part owner of Apple, Amazon, NVIDIA, great company, and I've done very well with that. And we vote on who is going to be running the company. So that's the board of directors. So the shareholders vote for the board of directors. The board of directors then hire the president and the CEO. So Elon Musk may be the CEO of Tesla and some other organizations, but he is appointed by the board of directors. A sole proprietor just means I'm going to go out and start my own business. A partnership means two or more people are going to get together. The problem with sole proprietorship and the partnership is liability. Now, you can cure this by going with a single person LLC, which is a limited liability company, and you can do a limited liability partnership, and that will keep your personal assets out of your business. So if you're just a sole proprietor and you don't have an LLC, then basically what can happen is that if you get sued, they can go after your personal assets. Same thing with a partnership. So, which of these pros and cons of each identify each of the following organizational characters with the organizational forms which they are associated. Easy to raise funds, that's a corporation. Simple to establish, that's a sole proprietorship or partnership. No personal legal liability, corporation. Tax advantages, sole proprietorship or partnership. Ease or transfer ownership, corporation. All right. So we're going to be going over financial accounting, and that means that we are going to comply with certain rules and regulations. We're going to be governed by the Securities and Exchange Commission. We're going to do our accounting under what's called generally accepted accounting principles. Um, Other courses will be talking about management accounting, and that is really directed internally, and that is for the purpose of helping you to basically improve your profitability and your efficiency. So it would be, hey, how do we price this product? What impact would it have if we changed from this vendor to another? Those are internal; they're not governed by rules per se, like external information is. So internal is cash sufficient to pay dividends. What price should we charge for our newest smartphone model? Can we afford to give our employees pay raises this year? External users, of course, are investors, people that invest in a company. That could also mean creditors. So if you buy a bond, then you're basically a creditor. If you're a bank and you want to invest in a company, you're a creditor. So this is external financial information, external users. Is Apple earning satisfactory income? How does Apple compare in size and profitability with Samsung? Will Apple be able to pay its debts as they come due? Apple, by the way, is a very highly leveraged company. So for every dollar of asset they have, they finance 82 cents of that. Data analytics. Okay, so ethics and financial reporting. If you're a stockholder, you want honest information so that you can make a decision. And that really is our product as an accountant is to provide financial information so that people can make informed decisions. So we collect information. We classify and code information. Hey, this is revenue, this is an expense, this is a gain, this is a loss, etc. And then we put it into a format that users can use to make decisions. But unfortunately, not all people are honest. During 2001, you had a lot, this Enron, WorldCom, excuse me, Health South was a stock that I personally invested in. And 3 weeks later, they discovered that 5 CFOs had perpetuated fraud. So, what do you do when you hire a new CFO? By the way, are you willing to commit fraud for us? I think I would run. So, anyway, you pass what's called the Sarbanes Oxley Act, SOX, and it basically says, hey, you will get audited and your controls, your financial controls will be audited so that you don't have repeats of these financial scandals. Um, Ethics. If you are ever in a situation where you feel like you're being ethically compromised, I would look for another job. Some of these financial frauds go on, but they're usually always detected. And it's easier to justify, but basically don't do it. All right. So there are three types of business activities depending upon what you're doing. Financing activities. Financing is raising money for the business. How do you want to finance the business? Are you going to take out a personal loan? Are you going to sell shares in the company to people? Are you going to use all of your savings and you would be the sole owner of this corporation? Investing activities. What kind of business am I in? Well, if I'm in the food business like Chick-fil-A, then I need equipment to be able to provide food. So I need land, I need buildings, I need drive-through windows, I need tables, I need chairs, I need pots and pans and cooking material and refrigeration material and storage and computers and software, etc. So when you buy these types of things, these items that will last longer than a year, those are investing activities. You sell them when it's time to get rid of it, and you sell them or dispose of them. This would include investments in other companies. That's investing activities. You can see here property, plant, equipment, cash, accounts receivable. And operating activities, that's what you do. All right. We operate. We're Chick-fil-A, so we earn revenue by selling food. We pay expenses for our food, for our salaries, for our insurance, for our electricity, for our gas, etc. Those are operating expenses. Those are expenses that we incur that we need to be able to be in the business we're in. Our product, again, is information. And for the accountant, what you're going to do is deliver 4 financial statements. The income statement. Did we make money? And these are all done in sequence using what's called a trial balance. And we'll look at that later on in the course. But you take the income statement, did I make money? Okay. If I made money, how much did I keep in the business? Or how much did I pay to the shareholders in dividends? And by the way, for C corporation, not only is the corporation taxed, but you as an individual, when you get dividends, also have to pay taxes on those dividends. Although if they're what's called qualified dividends, they're a lower tax rate. So how much did we keep in the business? And your retained earnings is how much you've kept in the business from day one. Balance sheet. What are my assets? How much do I owe? How much equity? This is also the accounting statement. Assets equal liabilities plus owner's equity. So if your only asset was a house and you have a house that's worth $100,000, you had $20,000 cash, which you then used as a down payment. And so that meant you had to borrow $80,000. Well, that $80,000 is a liability. So your $100,000 asset is equal to an $80,000 liability plus $20,000 of equity. Every transaction affects the accounting equation and the balance sheet. And lastly, the statement of cash flows. Where did I get cash? What did I do with it? And sometimes this is more important than even the income statement. You can hide things in the income statement. You can't, cash is cash. And the reason that an income statement and cash are not similar is because of generally accepted accounting principles and what's called accrual accounting. What that means is that the if we earn in revenue, even if we're not paid, we record revenue. If we have expenses, even though we haven't paid the expenses, we are going to put that down as an expense. The actual cash payment is a separate function. So again, we collect information, we classify information, we present this information. Information is collected when a financial transaction takes place. You buy something, you sell something, you use something. The general ledger is a group of accounts that are used by a company. So your checking account is a list of every transaction for your checking account or your cash. At the end of the month, you have a certain balance. You started the month with a balance. You added all your deposits. Okay, that's a positive number, which in accounting is called a debit. If you bought something or paid a bill, that's an expense, and you subtract that from your checking account. That's called a credit in accounting. So at the end of the month, your checking account is going to list every cash event. Every time you put money in the bank, every time you took money out of the bank, and you could go through and look to see what you used this cash for. So the general ledger is a list of all the accounts that you use. So if you were Chick-fil-A and you had a food account, every time you used food to make revenue or threw it away, you're going to expense that. So you'll have a food account and it'll list all the food you bought and all the food that you use. So an account is a list of all transactions for that account. A trial balance is a list of all accounts and their balances as to a particular date. Retained earnings statement uses the results of the income statement. So the income statement is always created first. Actually, in today's modern accounting system, they're basically all done together. But if you do it manually, you're going to have to do the retained earnings statement first. Then you use, or I'm sorry, the income statement first. Then use that information for the retained earnings, and then so you'll add beginning retained earnings. Or that would be your starting point. You add income or subtract loss, and then you subtract dividends, and that's your ending retained earnings. That goes on your balance sheet, and then you just put all the ending balances for all your other assets, liabilities, owner's equity. There are various ways you financial information match each of the following with definition, data analytics. Well, you can see the answers here. I'll let you go over them.